Hello everyone, welcome back to the IPO series where I will walk you through different aspects of going public based on my own journey at Zaggle. Today, let's talk about a fundamental question for any company going public. How do you decide your IPO size? In simple terms, this is the total capital you plan to raise from the market. At Zaggle, we first determine the structure. Would our IPO be all primary capital or will include an offer for sale, allowing early investors an exit? In our case, we opted for a balanced approach, combining fresh capital with the opportunity for early investors to pair their stake. Next, we'll go to the purpose. Why do you need this capital? Here is a breakdown of some of the purposes which we have seen in multiple markets happening. First, product development. Innovation is central to any company, and you need capital to continue investing in research, development, and new technology. This is crucial for one to stay ahead in their industry. Second is overseas expansion. You may want to expand into international markets. This is always a high-cost venture, but with the right resources, it's an excellent way to drive long-term growth. Third is working capital. It's another critical area. This is the lifeline that supports day-to-day operations, and you must ensure that your capital needs are met to maintain a smooth cash flow. The fourth, the opportunity for acquisition. You could also have your eye on acquiring companies that could complement or synergize your product line or operations. Acquisitions can fuel rapid growth, and having a dedicated pool of funds would allow you to act quickly if the right opportunities comes up. The fifth point, and is equally important point, is debt retirement. One of your goals could be reducing the debt, which will help free up cash flow for other business activities. Once you tally up the capital needed as primary across these categories, you are allowed to add a maximum of 25% on top, dedicated to general corporate purposes, which is called GCP. GCP is like a cushion covering those unexpected but inevitable expenses that pop up in the business, and that is how you put up a 25% cap on the GCP. Finally, you must assess your company valuation. This involves a deep dive into your intrinsic value, industry benchmarks, and current market conditions. The goal is to set a fair value that meets your capital needs without excessive dilution. Also, always keep in mind that you need to leave something on the table for the investors. Deciding your IPO size is all about understanding your growth needs, investor interests, and market readiness. Thanks for joining me. In our next episode, we will dive into pricing your issue and how important is pricing your issue. See you soon. Thank you.